Okay, moving forward to liquidity zones. So building off what we just talked about with liquidity. So we'll zoom in a bit and talk about liquidity zones and the fact that they're critical for how we frame trade ideas and we spot potential reversals or breakouts. A liquidity zone is basically a cluster on a chart where a ton of trading activity has taken place. Think of it as a zone where there's been high interest from both sellers and buyers. You'll usually find these zones form around consolidation areas, prior highs or lows, big round numbers, so psychological levels. Think like 100,000 on Bitcoin, very big psychological level, and fair value gaps or imbalance zones. So why do these matter? Because when price comes back into a liquidity zone, you'll often see a reaction. And that's where traders are trapped or where pending orders are stacked. It's where large players might have some unfinished business. They're looking to continue a move. These zones end up being magnets. So when price reaches that zone, it tends to gravitate in that area where liquidity is concentrated because that's where the most orders can be filled efficiently. But once price hits that zone, you can get sharp moves. You can either get a clean rejection or an explosive breakthrough, but generally a noticeable reaction. And that's why we pay really close attention to how price behaves inside the zone and not just the fact that it's in that area or in a range. The key takeaway with sort of the way that you inspect that is that you don't just mark the zone and then trade blindly into it or away from it. We have to watch for clues. Is liquidity being absorbed? Is it being rejected? Is volume increasing or is it fading? And that type of context will give you the edge or give you that setup that we were talking about with liquidity, that when it comes into one of those high frequency zones, one of those magnet areas that it approaches because there's a lot going on, a lot of participants, then if you have contextualized the price action leading into it, you have a much better idea of what's going to happen after it. If everything's being absorbed, then you're saying, all right, this is probably going to get faded here. Or if volume is expanding and price is moving up towards a zone, you might think to yourself, it's going to break through. This is going to be the one that breaks through. And then you can contextualize it through the patterns that you would have charted up to that point. So swapping over to the chart just very quickly, a really good way to help contextualize these liquidity zones using the VRVP we have over here, this huge column in the middle, that means the most participants of everything you see on the screen here, the most participants are sitting in this area here. And if you just draw a straight line all the way across, or my cursor, or even just this yellow dotted line, you're going to see the most candles interacting on that line than if you put a line anywhere else on the screen, because the most participants have been in this area. We've got buyers and sellers all over here, wick down here, over here, wick up here. This was that zone where it just kept coming back and there was always buyers and there was always sellers. And then in these other zones, so you can see there's far less down in this area because the only time on the screen that price made it to this zone was here. So there's far fewer candles. So in the context of what is on the screen right now, our biggest liquidity zone is in here where these largest candles are. And what you'd be saying to yourself, let's say you're up here in price is on the way down here. It touched that huge liquidity zone and then it rejected and went back up. If we look down at our other indicators while we were contextualizing this price action, seller volume is weakening. Seller volume is being absorbed as price moved down towards that zone. RSI was trending down, MACD was trending down. So everything was trending down, but there was less and less volume as the price moved. If you were seeing that and you're seeing this buyer volume start to pick up, as price came down towards our big liquidity zone here, you might think to yourself, it's going to get absorbed, it's going to bounce, it's going to go higher. And in this case, you'd have been right. As soon as price touched this area, not even multiple candles, one candle, it became all buyers. It was all buyers straight away. Now, that's not speaking to what happened in the following minutes. It's just the reaction when it touched that zone. And that's why liquidity is important, because things like that, you could have predicted what was going to happen on this move. You could have known, all right, I'm in a short, this is going to be my exit. Or you could have known this is going to be where I set a limit buy and taken the bounce to scalp in this area. Okay, liquidity zones and why they're important, creating supply, support, and resistance. So now that we've defined liquidity zones, we're going to talk about why they actually matter in our day-to-day trading. And that example I just gave is a really good indicator, well, rather overview of what we're talking about now. One of the biggest reasons is that they help form support and resistance levels. So starting with resistance. A resistance zone is an area where the price has consistently struggled to break above. Think of it like a ceiling. It's not just one price, it's often a range of prices. And just for context, in everything that we talk about, it is almost unique if you gave a flat line, a singular price where something exactly reacted off it. Generally, everyone should get this in their head. When you talk about a support, a resistance, anything, give it a range on either side. Pretend that there is a line and then there is a small range above and below that line where the same reasoning that you're applying to that line applies to that entire range. Because price doesn't react exactly to the cent, it will react in a zone rather than a line. Sorry, what were we talking about? We're talking about resistance zones, right? So it's a cluster of sell orders, and it's either people taking profit or it's short sellers getting in. It's liquidity providers fading the move. That's how those zones form. And then on the flip side, we've got support zones, and that's like a floor. It's a range where prices found buyers stepping in over and over again, and you'll often see higher volume reactions or wicks off those lows, signaling that demand is coming in strong. And that's what we actually just talked about just before on the chart. Now, here's how that ties back to liquidity zones. So when you have a zone, there's a clear buildup of trading activity, and it's usually also a key area of support and resistance. And when price returns to that zone, that's where we start to look for a trade, because we know that's the memory there, and that's where the traders are watching for it too. And this is actually another really key concept. It applies to Fibonacci zones, it applies to support and resistance levels. Nothing in the market is a guarantee. It's not a formula that you can just type in and say, yes, this is definitely going to happen. But because the concepts that we're talking about here are widespread, traders all know these things, institutions all know these things, algorithms are built on these principles. And if enough people or institutions act on that information, it becomes self-fulfilling. If everyone or 90% of people say price is going to react at this support level, and then everyone behaves as if that were true, the act of everyone behaving causes it to be true. And that is how the market behaves a lot of the time. Everything is self-fulfilling because we all have the same information and we're all acting as if that information is completely true. So that's just something to keep in mind because it holds true for a lot of concepts. So whether that zone holds or breaks gives us a huge insight into who's in control, and it's buyers or sellers is what we're talking about when we say who. So remember, zones can be dynamic. We talked about that before. A support zone that breaks can become a resistance on a retest and vice versa. We don't treat these as fixed lines. We treat them as areas, areas of decision, I guess is the best way that we're going to be talking about that. And just to build off that one, and then we'll take a break for questions. The polarity principle. This is a very important, very important principle, and we were just touching on it. So the polarity principle is one of the most powerful concepts, and it plays directly off the support and resistance levels. And the idea is very straightforward. Once a level breaks, its role flips. So when a resistance is broken, that same level often then turns into a support. And when a support fails, it often then becomes a new resistance level. So here's how it usually plays out in sort of a real-time, quote unquote. Price breaks through a resistance zone, strong move, momentum looks solid, and then it will pull back and it will retest that zone. And this is the key moment. That retest tells you whether the breakout is legitimate or if it was a fake out. If price holds the level and bounces, then that's your confirmation. That's where traders would be entering. And buyers would then step in, sellers to where the sellers used to be in control. And if it fails and price falls back through, that's a sign of weakness, and it often leads to a sharp reversal. So the same thing in reverse when we're talking about supports rather than resistance. And why that matters for us as traders is that these retests, these polarity flips, they create some of the best risk to reward setups that you're ever going to find. You've got a structure, a clear invalidation level, and you're trading where the other traders are all making the same decisions. So it's high confirmation. So always pay attention to broken levels and don't just trade the breakout. Watch what happens afterwards. You watch for a breakout, whether it's the up or the downside. Price comes back to test the breakout level. And then if it holds and continues back either up or down, then that's your confirmation for an entry of a trade.